the run for stocks and rates, and where both might go from here. Well, let's welcome in the Wharton School's Jeremy Siegel. It's nice to see you as always. Welcome back.
Thank you, Scott.
How concerned are you about this backup in rates?
It's not surprising, and because of the strength of the economy, because of the Trump program, which I think is negative for rates, could be positive for stocks, but not positive necessarily for rates. Scott, I'm looking at what the June Fed funds futures now said. I mean, looking at the month of July for that June meeting, only two cuts are built in for including the December meeting. So if we're going to have a cut in December, the market is saying only one cut in the next 4 meetings to get us to the middle of next year. Over 100 basis points of cuts have been wiped out of the Fed easing process since that September large 50 basis point cut.
Right.
And
Are you good with that?
That is something, that's troubling the market.
Are you good with that? Or I mean, you don't really think they need to overdo it in terms of cutting, right?
You know, I think the Fed says the long run Fed funds rate is 2.9. That's way too low. I've been saying that for a long time. I think it's somewhere between 3.5 and 4. Now we're 4.58 now, so we still got a little ways to go. But one has to remember that if we're going back to normal interest rate structures, the 10-year on average is between 100 and 150 basis points above the Fed funds rate. So even if we get to 3.5 to 4, that still says the 10-year is going to 5. And if Trump enacts every single tax cut that he wants to, if he puts those tariffs on, then we're talking about potentially higher. So that is a headwind for equities in 2025.
To what degree? To what degree is it a headwind? Does it change your whole forecast? Or just temper it slightly? What do you think?
I haven't made a 2025. Listen, there are a lot of very positive. There's a lot of very positive things about the Trump. I mean, first of all, the extension. Now that the Republicans have taken the House, I think there's no question that we're going to get an extension of the 2017 tax cuts. And that's very positive because, as we know, the Democrats were chomping at the bit for raising the corporate tax rate, cutting the capital gains rate. None of that's happened. That is very, very positive. Less regulation is very, very positive. In general, I think we need a lot of mergers of small and mid-sized banks. We need a lighter hand on other mergers. Although there's some ambiguity about whether, Trump is how anti or pro-merger he is. I mean, but basically that Trump is the most pro-stock market president in our history, in the sense that he judges his success or failure as a president more by the stock market than anyone that I ever remember or have ever read about. So he's not going to do something purposeful that is going to tank the stock market. Now, that doesn't mean that there's not going to be a bear market or that he can prevent a natural, ups and downs of the business cycle and unintended consequences in geopolitical events. But I'm saying is that he always keeps one eye on the stock market. That is a very, very positive factor for the stock market. But the bond market is concerned about very different things.